Good afternoon, everyone. Welcome to Business Trends, Benefits of Fixed Asset Planning and Cost Segregation. I'll be presenting today. I am Mark Rogers. I am the leader of the Fixed Asset Services Group. I'll be going through most of the agenda, short of probably the biggest piece, and that's cost segregation. And Travis Malajic will be discussing cost seg, and I'll introduce him and give a little bit of his background when we get to that section. So today, we're going to try to get through these 4 topics in the next hour. We're going to kick it off with a little fixed asset planning, a general overview of what this will look like. We'll dive into more specifics when it comes to cost segregation and what that discipline's all about. We'll do Section 179D, energy efficient deduction, which is looking to get extended this year, so a lot of exciting things around that deduction. We'll talk about that, and we'll wrap it up with construction tax planning. So 1, 2, 3, 4. All right, let's get into it. Fixed asset planning. So what you're looking at right now is the teaser to the webinar when you signed up. So very wordy, but I wanted to kick off with this just to let you know that we're going to stay true to these objectives. This is why you signed up. And really, let's just read verbatim the first paragraph. Fixed asset planning is an excellent way to comply with current tax law while identifying deductions that maximize cash flow and reduce income tax liability. So looking at the bolds, fixed asset planning really is going a step beyond compliance and looking for those deductions that are kind of hidden. There's no reason why you can't do both seamlessly and at the same time. A large majority of taxpayers, I would say, year in and year out, over-capitalize in this space. And what fixed asset planning seeks to do is to catch everything right away as it's happening and realize those deductions. Looking at the bolds, it really shows well if you have a lot of building and building improvement assets in your portfolio, historically or building right now. That's where a lot of the deductions kind of hide out. And so when we're doing fixed asset planning, we do use cost segregation engineering techniques to pull out these different deductions above and beyond your traditional cost segregation of a building. So let's dig into that a little bit, what I mean by that. All right, so why do we do it? Well, really it's free money. Within your fixed asset ledger is embedded significant deductions. So it reduces your tax liability, increases cash flow, and there's always long-term a net present value that's usually 10 to 1 of what you're spending to get that deduction. So it's really one of those, in the tax world, one of those no-brainer services. And maybe just as important, what fixed asset planning does is set up the framework to componentize your building improvements and building assets so that whatever happens in the future, as Congress is continually changing and creating new laws around depreciation, you're ready to take advantage of those deductions and don't let them slip away just because you don't know they're there. When do we do it? This is a great thing about fixed asset planning is you could do it at any time. You could retroactively do it. It's very easy. It's an automatic method change. You can look back and capture deductions that you just forgot to get. The IRS will forever let you depreciate something in its longest possible life. So they won't tell you. So unless you're looking, you wouldn't know. But if you find something, it's easy to go back and capture that. And the deduction is a year 1 Section 41A deduction. So you get it all within the tax year that you're doing the study on. The easiest way, just to do it as it happens. You build something, you improve something, you do some leasehold improvements, fix a roof. Grabbing these things in the year it happens is always the easiest way. and it kind of just slides right into your 4562, and you're maximizing your deduction year in, year out. And we're going to talk a little bit more about construction tax planning when we wrap up this webcast. But there is some thought that needs to be given into your CIP accounts, looking at those and what that means and where the deductions are and planning for that. So how do we do it? At the end of the day, we want to get, or you want to get, your depreciation that's sitting at a 39-year life or a 27.5-year life down to zero. That's the nirvana state, to expense it and to get that deduction right away. We do that a couple of ways: recovery periods, getting something into a 5-year, 7-year, 15-year bucket with bonus. Section 179D is another tool in the tool belt. Repair and maintenance. We see a lot of overcapitalizing in this space. A lot of times, GAAP book, your financial book might be capitalizing a large roof replacement, but that doesn't mean for tax purposes that you need to follow. There's a lot of law and examples out there that support, well, using roof as an example, an expense position. So if you find those supporting documentation, you ask the right questions, you talk to the engineers, you might get to a beneficial position. So if you can't get something down to zero, then we do cost segregation. Okay, so, well, we can't get everything to zero, but can we get part of it into a 5-year or 7-year? How can we find those deductions? And so we segregate. There's also partial dispositions. So if you do, let's use the roof example and deem it capital. Well, now you have 2 roofs on your books, and the old roof is probably embedded in a building number that is, I don't know, depreciating for 10 or 15 years, wherever it is, an overall large building number. You can carve that out. In 2014, the IRS set up some regulations to carve out that piece. So think when you're doing renovations or remodels, don't double depreciate. Go back and partially dispose. And then the removal cost. If you take a partial disposition, your demo cost can be expensed in year 1. It's a nice little catch, and a lot of times it's not realized. It gets caught up and remains in your building account, and it's depreciated over 39 years. And then, of course, energy incentives, which we'll talk about in a little bit more detail when we get to section 179D. That's a cute little graph. It shows the building life cycle. Kind of describes what I'm trying to get to. If you look at the top 0 years to 5 years to 15 to 30 years, what's happening to your building. You look at the green space. Taxpayers in general do a really good job in the green space. You build something, you acquire something, you're doing some sort of cost segregation, hopefully. If you're not, you need to. But the green space eats up most of the time and effort. The blue spaces, the light blue, dark blue, even getting to the gray, this is when you start to do some of your refreshes, your remodels, your improvements. This is where that roof example comes in, or maybe doing some HVAC replacements. You're remodeling a retail store to enhance the customer's experience. Things like that start popping up. And usually if book is capitalizing at a long life, tax will just go ahead and mirror that and put a 39-year, 27.5-year on this building component. Do not ignore this section. This needs to be assessed whenever you're doing your fixed asset planning. And for example, if you have $1 million building and you do a cost segregation, you find a $200,000 deduction because we were able to reclass 20% of it. That's great. That's wonderful. And that happens a lot. But what if you have a $200,000 roof repair or roof replacement that you're capitalizing that might be expensed just by the click of your fingers? There's another $200,000 just as good as a cost segregation that can be realized. So look in the other quadrants, know the life cycle of your building and where to find further deductions. Bonus. So the biggest thing that came out of the Tax Cuts and Jobs Act was bonus, and the depreciation was a great thing, right? We have 100% bonus for the next 5 years, and it's for new and used qualified property. And for those who do most of their portfolios acquisitions, you'll know that purchased properties did not get bonus. You probably still did a cost segregation on them anyways, because the recovery period going from 39 to 5 years, great. But now you got a kicker. Now you get 100% bonus on your acquisitions of buildings for qualified property. Again, to qualify, you need to hit the magic date of September 27th, 2017. So if you were going to build something anyways, and you had a contract in place before that date, you're not going to get that 100% bonus credit. And still that's okay, because you revert to a 40% bonus, what was the old PATH Act. So one way or another, you'll get bonus. That date just determines what type. And then this graph better shows the drawdown. So you'll see for the next 5 years, we live in a 100% bonus world, which really is just as good as an expense. Then it draws down to 80 in 2023, to 60%, to 40, to 20. And then we'll see what happens in 2027. We'll see what happens even before that. This is one of those things that may be made permanent, or they might ramp it back up 20, 40, 60, 80 to 100. Who knows? These things are constantly changing. We have lived in a bonus world of some sort ever since 2008. There's been some type of bonus. I think 5, 6, 7, or 6, 7, 8, there was 3 years of no bonus, but otherwise we've had something. So what qualifies? So it's not all buildings, it's not the entire building. You have to meet certain definitions. One is has to be qualified property. Qualified property is anything 20 years or less in a recovery period for tax purposes. So your 15-year land improvements, your 5 or 7 year equipment. And that's what's so great about doing a cost segregation or doing fixed asset planning, is we're trying to find the stuff you otherwise keep at 39 or 27.5 year and kind of chunk as much of it as possible down to a 20-year life or below. And then once you do that, you get the bonus. For as good as bonus was, the flip of that was improvements. And improvements, well, the thinking was, when they're coming up the new tax reform, was we're going to simplify. And they certainly did that. They did simplify. They got rid of all the qualified. Qualified leasehold, qualified retail, qualified restaurant went away. And they wrapped it all nicely bundled into qualified improvement property. It made it a lot easier. So if you improve something, great. You're going to qualify for this type of property. What there was an oops. I think I have a slide where I'll get to the oops after this slide. So this is a big deal. This is a really big deal. Looking at the definitions, really anything that is interior might qualify for QIP. And you want it to qualify for QIP. Think of your renovations and your remodels, to just lump all that stuff in and not have to think about it as much. I say that there is a little thinking. It's not an all or nothing thing. If you're enlarging the building, you have to be thoughtful on that. No elevators or escalators. Internal structural framework of the building. So roofs, windows, concrete flooring, on and on. You do have to kind of, it's like a reverse cost segregation. You have to pull out these real property items, and then everything else hopefully falls into this QIP bucket. And what shows really well with a QIP analysis is if you're renovating or remodeling, that's the time we can also get in there and get a nice partial disposition deduction as well. It's all part of the same process and not to be overlooked, and oftentimes is. So let's look at the oops. All right. So the intention of QIP was to assign a 15-year recovery period. So we're going to consolidate all these Qs. We're going to put it into a 15-year bucket, and life is going to be good. They forgot. to make it 15-year, which means qualified improvement property defaulted to 39 years. So now we have something called QIP, which is no better than a building 39-year asset. So it's not doing anything for anybody, and it's a shame. So the only way to fix that is a technical correction. And Congress, in their infinite wisdoms, needs to do that, and they haven't yet. They are talking about it right now, probably as we talk. They're holding hearings on this issue. It's being used as leverage, it's being bundled. It's not a standalone issue, this QIP. It's part of an overall correction package. So we're at a wait and see, but right now, we live in a world where QIP is 39-year property and has to be depreciated as such. So some of those on the call might say, well, I already filed on March 15th, and I couldn't wait to see if Congress would change this. I have to think, and we talked a little bit about this earlier, about automatic method changes, and it's easy to go back, that there's going to be some kind of unwinding the clock to capture these QIP items. Maybe an automatic method change, but we're just going to have to wait and see. All right, another good thing that came out of tax reform is 179. Those who know the deductions, usually a small taxpayer type of thing, you know that it's been increased to $1 million, phased out to $2.5 million. So looking through that example, you can see, look at the last row there, before $40,000 allowed, now $950,000. So all good stuff, all things that need to be considered when you're going through your fixed asset planning. Where do you want to capture 179 versus when do you want to capture bonus? When do you want to segregate? All part of the strategy. Also eligible are roofs, HVAC, fire protection, security systems, and would you look at that, QIP. So in this respect, even though QIP got messed up from a recovery point of view, it still slipped in to 179. So there might be a reason or a purpose for you to segregate out those QIP items, because you might want to use them in your 179D deduction. And again, 179 plays very nicely with partial dispositions. So while you're capturing that 179D deduction, make sure you get that partial disposition as well. All right, fixed asset plan. This is kind of a stream of conscious slide, but it is many things, and that's for real. Proactive, not reactive. Tool in your tool belt. It's just always a good idea to know your options and your scenarios beforehand. Where your deductions are coming from, when you pull the deductions. Things are very flexible. You can do it by building. So when you want to pull a lever, by entity, and how does that work? It has to be part of your overall tax planning strategy. And it sets the foundation for future dispositions. It sets up the framework. So how is it getting into your system? Are you just putting building, then personal property, then land improvements, then land, and that's it? Or are you kind of telling a story in your fixed asset ledger so it's easier to go back in time and capture things when opportunities pop up from Congress? So it's really fixed asset plan. It's a process. And once you get into a good process, a good rhythm, you can capture these deductions kind of seamlessly. I've seen it done monthly. And that's probably as frequent as I've seen it. More often, quarterly is when you look at your ads quarterly and say, okay, what can I do with these? And especially annually, at least annually, it needs to be part of your tax planning strategy, the interplay. So now that brings us to our first polling question. What best describes your current approach to fixed asset planning? What I see the most of is the first one, an annual exercise in compliance. B, or number 2, a periodic peek into material additions for deductions. C, or 3, a robust strategy to identify tax savings early and often. Or the last one, little attention due to NOLs and other issues where deductions are not meaningful currently. I'll give a little background on Travis. So we're going to talk about 4 different things. Fixed asset plan is one. We just wrapped that up. We're going to talk about cost segregation next, and there's no one better to do that than Travis. Travis has more than 11 years of cost segregation experience. In addition to this, he has more than 15 years of construction experience. He's a member of the American Society of Cost Segregation Professionals and is a licensed cost segregation professional. So he truly is Mr. Cost Seg, and we'll get to him right after this polling question. So no surprises really, 38%. Yeah, it's just an annual exercise in compliance, right? And so I think coming out of this, maybe we take a closer look at, use it as a tax planning tool. So let's move on to cost segregation. Travis, I'll give the floor to you.
All right, thanks, Mark. Appreciate the introduction. Hello, everybody. We're going to dive into the cost segregation world now. All right, so today we're going to discuss a few topics here. Go back and look at the history, how cost seg has evolved, started some milestones that really allow us to do what we do that have been handed up decisions. Define cost segregation. We're really going to go into the Eide process, how we look at a cost segregation study. Back to the Eide process, what we're looking for, big ticket items when we're looking at buildings. We're going to talk about tangible property regulations, how they interplay. Mark kind of touched on it a little bit with partial dispositions. Some success stories that we've seen very recently, some examples and some questions that are commonly asked. Interestingly enough, cost segregation can be traced back to 1942 with Bulletin F. And it was kind of the first time Congress and the IRS provided useful life guide for various properties. And then it kind of looked at the deposit and component depreciation strategies in buildings. And in 62, the investment tax credit, that's kind of when it really started to take off, which is different ways you could recover property, especially short life tangible property. In 81, obviously you had acres and some extra specified recovery periods. In 1986, the tax reform, we got makers, which is still the current system today. And then this is kind of where magic really started with cost segregation. Because in 1987, we obviously had Rev Proc 87-56. This is the class lives and recovery periods for most makers' assets. It's going to be based on industry and activity of the asset. And this is breaking down all different types of manufacturing facilities, different products that people manufacture. All of them have different little nuances, especially into the tax code and the recovery periods they can use. Hospital Corp of America was actually settled in 1997. It looks like I forgot to put the date on there. Sorry about that. But this is the landmark case for cost seg. It dealt with tax years 1985 through 1988 and was about $500 million worth of assets they were looking at. Obviously, Hospital Corporation of America, it's going to give it away as a hospital system. And, a lot of specialty equipment, electrical, plumbing, HVAC systems, stuff like that. And they went and looked at, the makers' investment tax credit, and they kind of came up with their own way of accelerating depreciation, and they won in court. They won the vast majority of the case, of their argument in the case, and a lot of it stuck. In 1999, that Treasury reg came out, and cost seg study considered a change in accounting method. This is also big because of the automatic changes we can do with the 3115. So if the building was placed in service 5 years ago, we just do a 3115, automatically change that accounting method do a catch-up adjustment on the depreciation you should have taken, the 481A calculation, and it's done. You don't have to go back and amend 5 years of returns, which makes it really easy to make those changes. Also in 1999, the IRS finally acquiesced to the validity of the method approved in the HCA case, and basically came out and said cost segregation is acceptable. Obviously, pre-81 ITC tests remained applicable under acres and makers, which is also key because that's what a lot of the HCA case was based upon. And then, as we all know how well everything works with Congress and tax law, it took them 7 years, and in 2004, the IRS published their audit techniques guide on cost segregation specifically. They continually monitored, updated with new law. As of right now, the latest revision was still from 2016. So the audit techniques guide doesn't have any of the new Tax Cuts Act in it, but eventually I'm sure it will have it in there. And this, the guide cannot be cited as authority for doing cost seg, but when we look at the ATG, it's really how is the IRS going to look at it if they audit a cost seg study. And so in there, there's 13 principal elements of a study. There's different steps we should take, and the IRS is going to look for. How do we approach our engineered calculations, stuff like that. And so we do follow through the ATG for our projects, and it's good on the back end. If anything ever gets looked at, we feel very confident that we're going to come out with no change in the cost seg study. So what is cost segregation? It's a process of identifying property components that are considered tangible personal property or land improvements within the federal tax code. Your section 1245 is going to be your personal property and tangible property that's used for your business activity. There's also other special use property that qualifies, but this is going to be your 5-year equipment, 5 or 7 year equipment, for example, depending on manufacturing or what the business asset or asset class is. You know, and then this can also go into special electrical, special plumbing. That's an integral part of that piece of machinery or piece of equipment or building. And then 1250 property, all depreciable property that is not 1245, basically boils down to structural components, your exterior walls, your HVAC systems, the overall plumbing system, electrical system, and then finishes that are permanently attached to it as well. The Eide-Bailey process, this slide that looks like a lot, but there's 8 steps that we pretty much go through every single project. We're going to qualify your property, which we'll get into on the next slide, so I'm not going to spend much time with that here. If you decide to go with Eide-Bailey, we're going to gather information about the building that we don't have from qualifying step. It's going to be like blueprints of the building, any other information that we may need, additional costs, etc. The site visit, we're going to come to your property. We're going to take pictures to document that we were there, to document the finishes, document the condition of the building. And that's not a required step by the IRS, but interestingly enough, if a study gets looked at, the very first question is going to be, where was this item in the building? Well, we don't see it, we don't know, we don't have that solid footing to stand on that we can defend it. So we do a site visit on every project, and it makes for a smoother project, a smoother outcome if it ever gets looked at by the IRS. After the site visit, we come back, we do what we call takeoffs, measurements. This is where we're going to quantify all the assets in the building that will qualify for a shorter recovery period. And then we price them all out. We use third-party pricing software. That's one of the quality elements of the study. And so it's third-party, it's unbiased, and then there are national pricing providers. So we factor it for your building's specific location, specific year it was placed in service, and then tie everything back to either your construction or your purchase cost. During pricing and after pricing, we're going to classify all those components into what we call property unit numbers, or PU numbers for short, you see on our reports. And this is just going to give a general summary of all the assets in your building on a shorter schedule, I should say, and it's easily able to be put into depreciation schedules or into depreciation software for setting up depreciation. Then it gets reviewed. It goes through 3 levels of review within our process right now, and then we'll deliver the final report to you as the client. In that report, you'll see the summary schedule of everything we found, a detailed breakdown of that summary schedule, which will show every component that makes up that total property unit cost, and then a full technical write-up with all the case law and tax law that supports our position in taking a certain component as a short life property. So the qualification process, we really look at a few things, and some of the common triggers that we need to have outlined before looking into a cost segregation study even makes sense is, do you own the real estate, and do you have taxable income? And so owning it, a purchase, construction, a renovation, if you're a tenant in the building, but you pay someone to do your tenant build out, that qualifies as well. Obviously, that's going to be like, your qualified improvement property now with the new tax law. So that would count. And then, do you have a taxable income? If you don't have taxable income, obviously accelerating deductions and creating more deductions might not be the most beneficial thing for you at this point in time. And then obviously, are you looking for additional depreciation deductions? In my opinion, I think everyone wants to save money on taxes where they can, but some people, they see it, the benefit might not be large enough, whatever, but that's what this process, that's what the step in the process is for. I was just going to touch on one more thing with doing a cost seg. You don't have to implement it right away either. You can, the building could be placed in service in 2018. Say we did the cost seg already, but you think you're gonna, have more taxable income in 2019, for example. You don't have to implement the changes of the cost seg study right in 2018. You can carry it forward, implement it on the 2019 tax return, and file that 3115. So it's not something you have to do immediately, but most people do take the deductions right when they get it. For qualification, what is needed? If it's a purchase facility, we like to see a purchase agreement and a closing statement. That gives us a great basis for costs. We do some things with looking at tax assessments and ratios for what the building versus land in a purchase should be. We can't actually provide you with a land number, but we can provide you with what we think it should be based on the tax assessment ratio of what that building was valued at. And then the client or your CPA would sign off on that number, and that's what we'd go with. For a construction or a renovation project, the final or the most current general contractor's AIA pay application, that's the easiest system for us to use for costs. We know that not everybody that has a general contractor. You might do a lot of the work internally, just have a lot of invoices, or you as the client were the general and you just subbed everything out. We take a look at all those subcontracts instead to get an idea of what the cost was. Excuse me. And then this all rolls into a no cost, no obligation estimate of benefit. And with this, we're going to run it through a system we've created internally, and we compare it to similar building types that we've done over the years. And we know where those ended up, as far as accelerated deductions. And so we're going to compare it to that based on size and other factors. And then we're going to come up with some percentages that we think we can move to 5 and 15 year, for example. And then the summary of our estimate is going to show you the accelerated deductions. And even though we have 100% bonus right now, So you're getting technically all the accelerated deductions in year one. We still like to provide you with a 5-year run out of what those deductions are, along with the tax savings of the first 5 years of owning the building or owning the improvement. And then the net present value, that's going to be the tax savings run out through the entire depreciable life of the building. So either 27.5 years in a residential rental facility or 39 years in a traditional retail facility. And then we're going to give you a fee range, and we like to do a range from the standpoint of, there's always negotiations. We can always negotiate the fee. It's where we think it's going to fall in, and then we can work with the client going forward on the fees. So how do the tangible property regs interplay with a cost segregation study? During the cost segregation, we do a lot of unit of property breakouts. What's the structural component? We're going to have the HVAC system broke out. We're going to have the plumbing system broke out, the electrical system, etc. During the cost seg, we're obviously going to be differentiating between 1245 and 1250 property. And then also within the unit of property, what's the major components? Obviously, your HVAC system, your major components are going to be RTUs. Funny enough, in a plumbing system, they consider a toilet the major component. In my opinion, I think the piping is more major than the actual physical fixture, but that's the IRS's view, not mine. And then obviously, what's routine maintenance versus a betterment versus a repair? And all those have different, they could all have different treatments. One's expensible, betterment's going to be capitalized. And then partial disposition calculations to go along with the tangible property regs. In conjunction with a cost segregation study, these are very easy to do. As we're doing a renovation project, for example, we're identifying what's new. Typically at the same time, we have demolition plans. We can analyze those right at the same time and get that partial disposition calculated as an add-on with the cost seg study. And then we can also do standalone calculations. Mark mentioned the roof earlier. If you just do a roof and that old roof is still being depreciated in the old building line item, we can come in, we figure out the square footage of the new roof, and we factor that back to when the building was created, get that same square footage of roof value estimated from the original building. A few success stories. We've kind of laid out 3 here. The first one is an apartment complex purchase with no bonus. And this is obviously pre-tax cuts. And this is kind of just 3 examples are going to lay out different bonus structures. But no bonus, reclassed $8.8 million of the $23.9 million purchase price. At net present value was $1.1 million. The fee on that project was $25,000. So obviously a very nice 44-to-1 return for that study. A retail store, this one was a jewelry store, $1.7 million in cost. They had 50% bonus, $600,000 reclassed with a $120,000 net present value for $8,000. And obviously retail stores vary from what they have. Obviously jewelry store, they have a lot of display cabinets, a lot of display lighting, extra little specialties that go along with, a jewelry store versus just your average American Eagle or any retail store, or Kohl's or something like that, like a big box store. There might not be as much of that specialty property as being a jewelry store. And I think to really see the effect of bonus, this was an apartment complex, $10 million with 100% bonus, $3.5 million reclass. The net present value was $638,000. So they're getting, a huge deduction up front with 100% bonus, and then obviously everything after that is a negative for accelerated deductions, but it still comes out very well with $638,000. And again, the fee on that one with a great return. So a few examples. This is looking at an auto dealership. some specialty things that we look for in an auto dealership specifically. Ventilation for the paint booths, that picture on the left, the screen, the red, that's a paint booth. The paint booth is going to be equipment treated as a shorter life, but all that ventilation that's going up there through the roof can also qualify. We're going to have display lighting in the showroom, plumbing services to equipment in the body shop, a lot of hand sinks, parts washers, car wash, stuff like that. Security systems that are used to protect the inventory. So if you got a lot of cameras outside, looking over the inventory of vehicles. And then land improvements are always going to be 15-year, most part. And then just common building assets with the potential for lower life. Millwork and cabinetry, equipment, power, flooring. And we say non-permanent because that's going to be like your laminate woods, your vinyl tile flooring, carpeting. As soon as you get into like ceramic tile or anything that's going to be permanently affixed, grouted, or we don't see it very often anymore, but back when hardwood floor was real hardwood, it was all nailed in, stuff like that would not qualify for shorter life period. And then obviously we've touched on quite a few of these FAQs already, but you have to do the study right when you place the building in service. No, you do the 3115 for the current tax year. No amended returns, a 481A catch-up adjustment. How much time is required by you as the taxpayer? This is a very big question that we get a lot, and really not much. Really all the time is going to be accumulating the information that we need, and like mentioned, it's mainly cost documents that you probably have that you can just email over or send us. Facilitating the site visit. This usually is about a half hour to 45 minutes of your time providing us a tour of the building. And then from there, we're usually on site for another hour to 2 hours, documenting with pictures and stuff like that. And then any questions that arise during the project is mainly always email communication, not much time there. And what makes us different from the competition, and this is obviously our viewpoint, but the quality and thoroughness of our analysis, we dive in pretty good to your building. And we want to make sure we maximize the benefit that you receive from us. Knowledgeable professionals. Mark had already mentioned I am part of the American Society of Cost Segregation Professionals. It's a national group of individuals from many firms, some big four firms, some small firms, and we get together and we set standards that we have to follow. And it's we have a conference every year that we go to and keep talking about new issues that arise. And then the ability to customize, and this varies greatly on how we customize projects, but some taxpayers, they might not need a full study with full technical report. It might just be a simple invoice review of, say 30 invoices from a small project you did. We can review those, tell you what recovery periods should be used, etc. Now we get to polling question number 2, and I have to thank Mark for this one with the wording, but it's a big one. What best describes your building/leasehold portfolio? Are you consistently putting improvements into your buildings or acquiring and building new ones? Improvements, any renovation, any upgrades to equipment, stuff like that. We are regularly putting improvements into our buildings, but are not acquiring or building mode right now. You've recently acquired or built your first building. And then the last option, we have little to no building assets, mainly just machinery and equipment additions annually. And with that, while you're voting, we're going to turn it back over to Mark, and he's going to continue on with energy incentives.
So you're probably wondering, how are we going to get through 2 polling questions in the next 10 minutes? And I'm hungry too, so I am well motivated, and we'll get through these last 2 sections efficiently. So first one, very important, section 179D. This is an energy efficient deduction. You could read there, there's a $1.80 deduction per square foot available if you are building efficiently with your HVAC, your envelope, or your lighting. This opportunity is for building owners. It's also for designers of governmental buildings, and those governmental entities are able to dole out the deduction. So one or two ways to get this deduction, and hey, this couples nicely with the cost segregation process because we often do these projects concurrently. We're doing the site visits, might as well grab this deduction too. It's something that at the very least needs to be thought of. So it got extended through 2017. We're waiting on 18. Again, just much like the rest of fixed assets, we can go back and do a 3115 and catch these items if you didn't get them the first time. If it is a government entity that's assigning to designer, an architect, or an engineer, then that's an amended return. Okay. As far as where this stands, so there might be only a handful on the call that this applies to, but know this, it is looking good for extension. In February, on February 28th, 19, Finance Committee Chair Chuck Grassley, he's the guy from Iowa, and Ranking Member Ron Wyden from Oregon, put this out, what you're seeing on your screen right now, saying, hey, let's extend this not only through 18, but through 19 as well. This is going on as we speak in the House. They're talking about it. They're holding hearings, just like they are with the QIP and the technical correction. So know that you can go back in time and capture it, and also know this might get extended a little farther. So the process, really, you'll see a lot of overlap with what Travis is talking about with cost segregation, looking at blueprints, doing a site visit, and then here's where it splits off, doing a energy simulation with IRS approved software, and then getting certified by a qualified individual, usually a PE. So strong indicators that you might qualify for some of this deduction. Remember, 60 cents, 60 cents, 60 cents, 1, 2, 3, up to $1.80 per square foot is the level of insulation you're building, the HVAC efficiency, and the LED lighting. Some indicators, well, regulations have not kept up with building science, that's for sure. It's not that hard to get this deduction. Think about when you go to Home Depot to get a new light bulb. You can't even get an incandescent light anymore that's not energy efficient. You're running into LEDs. So just the way you are building right now, your buildings are being built, you probably qualify for this deduction. You don't need to be super LEED certified, platinum, and all these other things to get considered. So again, if you're a privately owned building, not government, this could be on your 3115 looking back, or if it's in the current year, you just throw it onto the other deductions. It's a really easy grab. You just got to do the work to get there. If you are a governmental, or you're working on governmental buildings and you are a designer, there's an allocation letter. And the one thing I want to note about the allocation letter is look at I won't make you read the whole thing, but it says, to encourage energy efficient design in government buildings, a special rule allows the government agency to assign the incentive to the designer. So if you read that, how can AOC and the other new Green Deal House members not extend this? That's right, that's their mantra. So we're thinking positive thoughts that this will get extended for the taxpayer through 2018. Really quick, some case studies. Looking at a fine arts center, this was new construction, great insulation ratings, good windows, LED lights, and at the end of the day, looking at about an 80,000 square foot building, and getting a nice deduction there. Elementary school, a renovation. You'll notice square footage, 41,000. Got all $1.80, all three. Sometimes you only get 60 cents. Maybe you only qualify for the lighting. That's still good. Still a great deduction. All these examples are getting the full benefit of all three. But just another thing you got to look at, not just do the cost seg. Look and see if you get the 179D deduction. Look if you get these other things that are all part of the fixed asset planning and grab it at the same time. I'll just roll through and let you see. Here's another equipment dealership. Look at those deductions. So we'll go straight to the polling question. And number 3, do you have facilities in your portfolio that are over 40,000 square feet? So this is a per deduction or per square foot deduction. So square foot is kind of meaningful. And right around that 40,000 square feet, that's where we tend to see value, and that you should explore that. So a simple yes or no question. And for the handful of you that this will apply to and you want to know more about this, we're going to have a whole webinar on this on April 16th. And then again, a full-blown one with Joe Sawatsky, our energy efficient leader in this space, and that's on June 11th, 19. So if you want to know more about this, go to idebailey.com, search the keywords 179D webinar, okay, and you'll find these 2 dates and register just like you did for this one, and you'll really get into the weeds for that. Okay, we have 5 minutes to get through my favorite one, and that is construction tax planning. So this is really being proactive, not reactive about getting your deductions. The teaser we have on our slip sheet is this. I'm just going to read it verbatim because it shows well. The journey through the construction process is challenging but rewarding if planned properly. Accounting for fixed assets is complex, however, often the reward is overlooked. A proper tax planning strategy around your construction project is paramount in realizing short and long-term federal tax benefits. So you give a lot of love to building your building. You should get a lot of love on the tax side of it too, and how it's being built and how you can reap tax benefits and deductions. And that's what construction tax planning is all about. It's taking segregation to another level, looking at componentization, even advising on material choices, talking with the architects and the engineers about how to install or what material to use, turn into significant deductions. And there's no reason why tax cannot be part of that conversation, because you as an owner, as a building owner, are paying them to essentially design something that's efficient on all levels. We do it in 4 stages. We assess as early as the design stage and create hey, what's your tax objectives? What do you want to get out of this? And we set up a course of action. Then we periodically follow up. It's usually monthly. That's how often the general contractor is giving you draws, right? That you have to pay for the construction. And then we're giving back advice on how they break out those costs. Or, hey, what if you use this flooring choice as opposed to another? Or maybe you attach this canopy this way and you can realize a big deduction. And what that happens is we can find these deductions, maximize the deductions, and give you projections throughout the project of how it's going to shake out onto the return. And then probably the most important is, you do all this hard work in any of these disciplines, but especially in construction tax planning. How does it get realized on the fixed asset software so it's meaningful, it's correct, and actually gets reflected onto the tax return? So prime environment doesn't happen too often. It's not like in everything like cost segregation, you should do it every single time. For construction tax planning, it's usually those who like to plan ahead, who are proactive. General contractors like doing this for their clients. So we team up with them, developers with multiple investors that want to plan ahead and know how everything's going to shake out. Usually a construction period of a year or greater is where this steps in, but certainly we can do it for any time period. Okay, 2 minutes left. One more polling question, one more slide, then a polling question. So the one thing I want everyone on this call to get out of this is there is benefits embedded in your fixed assets. And if you have income and are in the mood for deductions, and there's plenty of ways to find those deductions, start with or at least make fixed assets part of that. Or if you're just coming out of net operating losses and all of a sudden deductions are meaningful, let's look back. If you haven't scrubbed in over 3 years for retroactive opportunities from tax reform and tangible property regulations, let's do that. We just this month, I had someone come to me and say, we want a cost seg done on a $30 million new apartment complex. I asked one simple question: can I also look at your historical fixed assets? They said yes. And I found them another $2 million deduction and some renovations on some other properties they were working on. So it's always a good idea to get these assessments. They're free. Not many things are free. The assessment will tell you what's going on, and then you can pull the lever from there. Why free? Because taxpayers overcapitalize, quite simply, and we can help put an end to that and get you onto a process and a system where you're maximizing every dollar. Okay, 1 minute left. I think we're going to pull this one off. One last polling question, number 4. When was the last time you assessed your fixed assets for tax saving opportunities? First, A, we don't pay too much attention to this, not a priority for us right now. B, we review at a high level, but we should get into a better rhythm of knowing what is available to us. And C, we are fairly diligent on assessing large opportunities, but could be better overall. And I suppose it could be a D, that you're doing everything perfectly already, but I don't see too much of that. Let's see how this shakes out. Right about in the middle, highest at 40%, don't pay too much attention, not a priority, or reviewing at a very high level. All right. Well, we're at the 1 o'clock mark. I think we're in a good place. Thank you very much for hopping on. Hope to see you again on the Section 179D webcast, and have a great afternoon.
Awesome. Thank you all so much. And if you do have any questions, feel free to reach out to us and we'll get those questions answered. Thank you guys and have a good day.